Why concentration risk hides inside diversified portfolios? Diversification is meant to protect capital. Allocators distribute exposure across tokens, strategies, custodians, and protocols in pursuit of resilience. But in digital markets, diversification at the asset level can mask concentration at the infrastructure level. When stress appears, those hidden connections matter. Asset diversification versus infrastructure dependence. Traditional portfolio construction focuses on sectors and asset classes. Digital portfolios often separate Bitcoin, Ethereum, DeFi tokens, staking strategies, and stablecoins. Yet beneath those allocations, many positions rely on overlapping systems, shared validators, common custody providers, identical Oracle networks, the same stablecoin issuers, shared middleware infrastructure. The result is structural correlation hidden beneath apparent diversification. Custodial convergence. Institutional adoption has concentrated custody among a small number of regulated providers. This improves governance transparency, but it also centralizes operational risk. If multiple portfolio positions depend on a single custody framework, disruption at that platform can impact the entire allocation simultaneously. Custody becomes an infrastructure dependency rather than a neutral service layer. Oracle and pricing dependencies. Decentralized finance depends heavily on Oracle networks to deliver pricing data to smart contracts. Many lending protocols and collateral systems rely on the same pricing feeds. If Oracle updates fail or become delayed during volatility, liquidation cascades can occur across multiple platforms at once. What looks like diversified exposure becomes synchronized risk. Stablecoin concentration. Stablecoins function as liquidity rails in digital portfolios. They support settlement, margin, and collateral. Yet a large share of trading and DeFi activity relies on a narrow group of issuers. Exposure across several platforms can still mean dependence on one underlying stablecoin. If redemption stress or regulatory pressure occurs, correlation emerges immediately. Middleware and infrastructure layers. Digital asset ecosystems also depend on technical infrastructure behind the scenes. Node operators, API providers, settlement middleware analytics, and routing systems. Outages at these layers can interrupt transactions, distort pricing, and delay rebalancing. Token-level diversification cannot eliminate infrastructure dependency. Rethinking diversification. True diversification in digital markets requires structural analysis. Key questions include: which validators secure each chain? How are custody providers segmented? Which Oracle network feeds each protocol? How concentrated is stablecoin exposure? Which infrastructure providers support transaction routing? These questions reveal risk that asset allocation alone cannot detect. Kenson Investments helps institutions evaluate infrastructure correlation, custody exposure, and structural dependencies across digital portfolios. If your organization is navigating digital asset diversification, clarity begins with infrastructure mapping. Visit kensoninvestments.com and connect with our team.